In this video, I'm going to reveal the shocking truth about the mortgage interest that the banks don't want you to know. You could be wasting thousands and thousands of dollars. In fact, how about if you can save thousands of dollars? But don't worry, I'll show you how to escape this trap and pay off your mortgage years ahead of schedule. Stick around because this could save you from a financial disaster. Hi, I'm Mike Patel from Anaheim Hills, California. I've been selling homes for over 20 years and I've sold hundreds and hundreds of homes. And I've helped my clients save thousands and thousands of dollars by implementing this simple strategy to save money. So let's go ahead. Let me show you how to do that. I enjoy sharing ideas. And if one understands how money works and how mortgage payment works and your monthly payment works, one can save a lot more, and it'll be easy for you to understand how to save money and how to implement this easy system. I will start by showing you quickly how mortgage interest work and how much mortgage, just the interest, you will end up paying over the life of your house that you own over a period of 30 years. Once you understand that, I will also show you 5 tips on how to save money, how to save on mortgage payments, and how to pay off your home earlier. Rather than 30 years, you can pay it off in 25 years or 30 years or even in 15 years. So let's look at those tips. When you buy a house, typically a buyer looks at the mortgage payment, which is the principal and the interest. So if you talk to a lender and he or she qualifies you for up to $1,000 a month payment, that's what you look at. But typically a buyer does not look at the actual mortgage payments they will be paying based on the interest rate. The higher the interest rate, the more expensive the house is. So I'm going to show you in a chart how much the house actually costs you. You may think you're buying a house for $400,000, it's going to cost you $3,000 a month. But no. It's going to cost you almost $800,000. Let me explain. By the way, most buyers don't think about it. Most lenders don't tell you about this because the banks don't want you to know how to pay off your mortgage early. But a lot of clients that I have and a lot of people that I know actually use this system or these techniques to pay off your home early. So don't let the banks win. They're already winning by charging you a high interest rate, but don't let them win by not having you save money any way you can. Let's look at this chart. Let's assume you're buying a house for $400,000 and you are not putting any down payment and the mortgage rate is 6.5% for a 30-year fixed loan. So if you look at this chart, your monthly payment will be $2,528.27 a month. Most buyers focus on this number. Hey, guess what? I can afford $2,500 a month and this is how much the house is costing me. But let's look deeper. If you look over here, the total principal of the house, your loan amount is same as the purchase price in this example. So you're paying $400,000 for the house, which is your principal. And after 30 years at 6.5%, you can see that the total interest payments you will end up paying will be $510,000 and $177. So the total house it'll cost you when you add the principal and interest after 30 years will be $910,177.95. So the house is costing you quite a bit of money. Let's look at how the mortgage and interest payment work. So on your first month, if you look at the chart below, payment due on August 2024, when you make a payment of $2,528 in August of 2024, your principal is $361.61 and your interest that you are paying that month is $2166.67 for a total monthly payment of $2,528.27. When you go to the next month, because you paid a principal in August, now in September, your principal is $363.56, your interest drops to $2164.71, and your principal increased, so your total payment is still $2,528.27. Because this is a fixed rate mortgage, every month your mortgage is the same. But if you look at it, every month that you pay, your interest drops and your principal increases. On October 2024, your principal will be $365.53 and your interest will drop again to $2162.74 and your total payment is $2,528.27. So in other words, every month that you pay, you're paying more and more towards your principal and less towards the interest. But at the end of the day, those interests are going to cost you $510,177 over the life of 30 years. So when you purchase a home, you cannot just rely on principal and interest and your payments. Hey, I can afford a house for $2,500. You have to look at your interest payments, you have to look at your purchase price, because the lower your purchase price, the lower your interest rate, the less it's going to cost you over the 30-year period. So let's look at another example. So with the same house, but with the interest rate of 5.5% with a 30-year fixed loan on a $400,000 purchase and a loan amount, because in this case we are assuming zero down payment, your total monthly payment is $2271.16. At 6.5%, it was $2528, but at 5.5%, it's $2271. So you're already saving almost $350. If you look at your total house cost, which is $400,000, and your total 30-year interest payment, if you keep your house for 30 years, it's $417,616. So this house will cost you $817,616 versus the house at 6.5% cost you $900,000. So just by 1 percentage point drop, you are saving almost $80,000 in interest payment. That's how much difference a little bit works, because this is compounded interest and you're looking at interest over time. So the faster you pay, the more money you save over the long run, and the more time you save on your mortgage payments. Before I give you the 5 tips on how to save on interest payment and on time, I wanted to show you a simple example on how you save 9 years on your mortgage payment. Not only 9 years, but how much interest you save. If you look at this chart, we are assuming the same home price, $400,000, the same interest rate, 6.5%, 30-year fixed loan, and we are assuming 0% down payment. So in our previous example, your mortgage payment was $2528.27. Now, let's assume that you pay $390 extra every month from day one. And this is just an example to explain to you how money works, how mortgage works, and how you can save, because little things make a big difference. So in other words, if you pay $2528 a month, and then if you pay $390 every month and apply it to principal, so when you send a check or wire transfer or ECH the money, you have to tell the bank or the lender to apply it towards your principal. So if you do that, your mortgage payment on this house will be paid off 9 years earlier. If you look over here, it is 9 years earlier. This results in savings of $177,355 in just interest. In other words, if you pay $390 extra per month from day one, you will save 9 years. And in the previous example, your total house cost you, principal and loan interest, was about $910,000. In this example, you drop the total cost of the house to $732,000, which is a big savings. And I know a lot of my clients do that, and a lot of the buyers that I know and other clients, they actually do this. Of course, you don't have to start this on your first month. Start whenever you can, whether you're in your 3rd year or 10th year of payment. Anytime you make extra payments, you will save money. So let's look at those 5 tips that I was talking about. Tip number 1, anytime you can make extra payments, make those extra payments, because by making extra payments, you'll knock off 2, 3, 4, 5 years off your mortgage payment. Instead of 30 years, you could pay it off in 25 years, and you'll save a lot on interest. So let me give an example. If we look at this chart, and we're going to assume the same thing, $400,000, 6.5% interest rate. In this example, let's say I decide to pay $100 a month from the get-go, every month going towards my principal. You can see that if you do that, you will knock out 3 years and 2 months earlier, and this will result in the savings of $63,000 and $917 in interest payments alone. So paying $100 a month will save you $63,000 almost over the period of 30 years, which is a significant savings. Let me give you the same example by increasing the principal payment. So again, $400,000, 6.5% interest rate. If you make $500 a month extra payment in principal every month from the get-go, then, in other words, your mortgage payment ends after 20 years, and you will save a total of $205,557 just in interest cost. So this goes a long way. So anytime you have $100 extra, $400 extra, $500 extra paid off, if you cannot make it every month, pay whenever you can, because it makes a big dent in your savings and in your cost of your home. Second tip is anytime you can make a lump sum payment, that'll help you a lot as well, especially if you have a higher interest rate, and especially the earlier you do when you buy your house. So let's assume that the first year you bought a house, you got a gift of $10,000, or you got a refund of $10,000, or somehow you got a hold of $10,000 and you paid that as principal and your lender allowed that. Please check with your bank or lender if they allow paying extra. and if they allow extra payments on principal. But I'm giving it to you as an example. So in this example, if you look on the chart, by paying $10,000 one time, you will save $54,998 over the life of the loan. Significant amount just by paying a one-time lump sum payment. Tip number 3, you can make lump sum payment of one time, or in this tip, what if you make a lump sum payment every year? In this example, let's look at this chart. Same amounts in this example. Let's say you pay $3,000 a month every year. You work extra, or you work part-time, or you do a side hustle, or you have a bonus every year of $3,000, and you're making that $3,000 principal every year. Then over the 30-year period, by doing this alone, you will save 6 years and 5 months, and a total interest savings will be $126,940 in interest. In the original example, if you paid your $25,28 a month, you would have paid for the house $910,000. If you pay $3,000 a month lump sum per year, in this example, your total house cost instead of $910,000 will be $783,237, and $237, a significant saving. What $2,500 or what $3,000 a year extra payments does to your mortgage payment. It's significant. It knocks out almost 8 years out of your payments. Imagine when you retire or you pay off your loan 8 years earlier. What a joy that would be. Hope you plan for it. I wanted to take a quick moment and thank you for watching this video. But before I give you the 4th and 5th tip, I wanted to see what you might be doing to pay extra payments, or what system you would be using, or what tip that you like best. So if you can comment below and see what you might use or what you are doing already, because there are some other hacks as well, more than 5 hacks out there, which I will talk in my future videos. But if you have any ideas, please share with us. We would really appreciate it. Tip number 4. This tip is one of the most used out there. At least most of my clients who do interest savings use this idea or this tip because it's very easy to do and it doesn't really cost anything out of pocket. So what is that payment? It's called the bi-weekly payment. Let me give you an example. In our example, we had a payment of $25.28 per month. So let's assume you pay that on the 1st of the month. $25.28, you write a check every month, or you wire transfer it every month to your bank. But if you split that payment in two, $25.28 divided by 2, which is $12.64. And I'm going to give you an example. You pay $12.64 on the 1st of the month, and you pay $12.64 on the 15th of the month. You're not changing any amount of payment. You're just splitting it in 2 and then paying it half and half every 2 weeks. By doing this, what ends up happening is that at the end of the year, you make one extra payment per year, which means you make $25.28 per month payment one every year. By doing this alone, which costs you no extra, all you're doing is paying the same amount, but every 2 weeks, because it was divided in 2. If you use this system, what we call the bi-weekly repayment, you will knock out 5 years and 9 months of your mortgage years, and you will save a whopping $114,352, which is a very simple idea to do, and most people use this too. Hope you use it and see if that works for you. The 5th tip is pretty simple one, and that is what we call do a refinance. Obviously, you can only refinance when you have a higher mortgage payment. Let's say you have 7%. If you bought a house 1 or 2 years ago, you're paying 7.5%, and now the rates are 5%, then you may want to refinance. So in our example of $25.28 payment, if you had a mortgage payment of $25.28 at 6.5%, and now the rates dropped and you refinanced at 5% interest rate, then your payment drops to $21.47 per month, and the total payment that you will pay, your house purchase and your interest over 30 years, will be $773,000 versus it was $910,000 at 6.5%. So refinancing is a good idea. It doesn't matter if you have 25 more years left or 27 years left. Anytime you refinance, it's a great idea. A lot of people also use refinance to pull some money out. Maybe they need money for medical emergency, or they need money for college, or they need money to invest in a business. Although it's not a great idea, people, when they refinance at a lower rate, they also pull out some cash, $20,000, $30,000, $40,000, $100,000. Maybe they want to do a remodel, but you keep your payments the same because your payment is dropping from, let's say, $2,500 to $2,100. So you're saving $400 a month. At the same time, you pull some money out so you can use that for whatever you want. So refinancing has a lot of advantages, and you can use it the way you want it. It's just to pay it off earlier or pull some money out and use it for some other uses like education, medical emergencies, paying off high credit card bills. If you have credit card bills Right now, they're 25%. So if you have a $15,000 balance and you're paying 20 to 25% interest rate, yikes, that's a lot. Refinance and pay off that credit card and other debts and save at 5% interest rate or 4.5% interest rate. In 2021 and 2022, half the US homes, or more than half the US homes, refinanced at 2.5%, 3%, 4%, 4.5%. And when it drops, hopefully you can do that as well, because it's a huge, huge, huge savings. Small numbers, but over 30 years, they add up to humongous numbers. So what do all these ideas have in common? It's one common thing: pay extra principal payments. The more you pay, the better off you are. The faster you pay principal payments every month, every 2 weeks, every month, every year, the more you save. The whole idea is understanding that the mortgage interest is based on time and based on your interest rate. So the sooner you pay off and the faster you pay the principal, the less you pay in interest and the more you save. So I hope this gave you some information and you can implement some ideas. If you have some comments, please make them below. I really appreciate it. Sell smart so you can gain more. And I have a video in case your house is paid off, or if you have questions about title transfer and using quit claim deed. I did this video. Please take a look at it and hope you watch my next video. Thank you.